Gentlemen, we had confidence, consumer confidence slamming into reverse today, which to my way of thinking just shows that the government's budgetary promises can't fool all Australians all of the time. And so it's interesting to see that this fall in sentiment shows that people are still paying down debt and hanging on to spare cash despite the lower interest rates. So in the short term, a crisis of confidence in the economy has to have an impact on the market. My thoughts are that in the short term we're probably in for a bit more market pain, but the real question is, does an election result in September represent, the holy grail for the market and a year-end market rally? So we're in the doldrums at the moment. Is confidence going to climb out in the second half of the year, and will we see that result in the market perhaps moving to 5,500? Dave, your thoughts first.
Well, let's go back a step, Kim. I think the last 10, 11 months, the market has done superbly well despite the economic environment not being overly optimistic. What we're seeing at Montgomery now is a bit of contagion where the resource service companies have absolutely crashed in the last 3 months. On average, they're down about 50 percentage points, despite the fact that the market's up about 10% calendar year to date. And what I'm quite worried about is that there's some contagion and Australia develops a one-speed economy, which is the eastern seaboard slow economy, rather than this two-speed economy. And I think, given the valuations on a number of stocks, I'd be definitely starting to sort of think about taking some money off the table. And I think this election coming up on September 14, can only be positive, because there's no doubt there's a lot of uncertainty around. And as Hawke used to say, if you can't manage your own party, how can you manage the country?
Doug, welcome to the program.
Yes, thanks, Kim, and g'day, boys. Really enjoy Wednesday nights, especially. Yeah, Fleetwood, I had a look at it after the profit downgrade, and a couple of things really concern me about it, and I'd sort of appreciate the comments. First of all, it looks like it's only going to earn about 16 cents a share for the year and puts it on a ridiculously high PE. And the second thing I noticed in the last half year was that they paid out 20 million in dividends and also borrowed 20 million. So is there much prudent financial management going on at Fleetwood at the moment?
Ben, this is a good one for you because we've talked about this numerous times on the program. And it was and it did run up to about $9.50, $10 a share, and everyone was in love with the stock because it had a high dividend payout ratio and it couldn't put a foot wrong. With this profit downgrade, it was interesting to also note that Fleetwood did say that earnings would be down, but there would be a corresponding but not necessarily offsetting pickup in profits in the caravan side of things. So the actual commentary from the result didn't seem to be that bad, but the market just absolutely hated it. Now, has this stock actually gone into an oversold position? Well, with your funds, Dave, you obviously use valuation models to determine what's cheap and what's dear, but I mean, some of these stocks must actually be sort of starting to crazily veer towards that, looking like halfway reasonable buys with the falls that they've had versus the valuation versus where their balance sheets and their profitability sit.
Yes, but what we also need to do is we need to have a rising intrinsic value, and none of these stocks have rising intrinsic values. All their intrinsic values are falling, so we don't own any of them, fortunately. The problem, Kim, and I think Ben touched on it very well, was, we've had a sort of come to Jesus type moment with some downgrades in the last bunch of weeks, but that's for fiscal 13. We haven't seen anything for 14 or 15 yet. And as you say, the CapEx spend, if it crashes to the degree we think it will, then what's going to happen is we're going to look back in a bunch of months' time and say, is the resource service super cycle, is it over? Again,
that's the point, is that everyone being too bearish on that CapEx crash, because that's what the BREE was saying today. It's not actually a crash, it's more of a, it's a decline over a number of years out to 2017, so it's not like, the tap is being turned off next week or next month.
But if you've been making supernormal profits and suddenly BHP cut their CapEx and exploration budget by $7 billion a year over a 2 or 3 year period, and Rio cuts their cost base by $5 billion, and things like Browse are just cancelled, and other significant LNG projects are either cancelled or waylaid, and all these companies have set themselves up for enormous amounts of work that just no longer there, then suddenly as contractors they have to push off their staff, fire their staff dramatically, pessimism prevails, and suddenly there's houses on the market throughout Perth because of really, people think it's never going to end.
Yeah, okay. All right, well I think we might, because I want to come back to this topic because there's the issue of what's going to happen with the mining services, if there's going to be consolidation or what. But it's time for a quick break. Before that, though, it's time to start the stock watch. David, what are you watching? And your time starts right now.
At Montgomery, I'm watching IMF. This is a funder of class actions. It's currently got a book of about $1.5 billion. It's got 26 cases, and the bulk of those cases are worth well over $50 million each. We value the stock, which is currently about $1.90. We valued it at about $2.50. It's got a very strong balance sheet, and we think some very successful class actions are imminent. So we think it's got 20% upside. IMF is the ASX code.
David, what sort of multiples is it trading on at the moment?
Oh, it's single digits, Ken. Yeah, it's got quite a unpredictable earnings stream because obviously when you've got 26 legal cases, you don't exactly know when they're going to settle or not settle. So for example, Wivenhoe Dam they may take on as a case, and that may settle out of court, it may not. So the predictability of the timing is low, but the earnings stream over the years is very, very solid.
Okay. All right. Our next call is David from Sydney. Welcome to the program, David. David, are you there? Yeah, hello.
Hello.
Yeah, David, welcome to the program.
Okay, mate. Look, thanks. I just was listening to Martin Parkinson yesterday, sort of chatting at the sort of economist conference, and one of the points that seems to have gone past everyone is that essentially what he seemed to be saying was that while the mining industry was still pressing on, that essentially the rest of the country was in a recession in terms of its economic growth and development and capacity and whatever, and that he was concerned that this had really got to the stage where we're seeing some major problems. Now, the consumer sentiment data we saw today would seem to be sort of backing up that view.
Yep.
That we've got a really much larger problem than anyone is acknowledging. In the non-mining sector. And just as a Philip, can I ask about Silver Lake Resources?
Silver Lake Resources. Well, that's probably the most interesting part of your question. Silver Lake Resources. Well, I mean, this is the gold sector. It's just been absolutely pounded. And every time you look at what's going on in the gold price, these gold stocks are just trading at ridiculous discounts. And I've been looking at Silver Lake trying to find a point to get as an entry price, and every time you look at it, you think, geez, that looks cheap, and then the next day it's even cheaper. So, that's with Silver Lake, with the merging with Integra, you've actually got a producing gold miner. Of course, the price that they're producing at is critical to their success. And Silver Lake, I think, is around the $800 an ounce job. But Silver Lake generally, and the silver the gold stocks. Is it still way too early? Do you stay with
I'll summarise. We don't own any gold stocks, Kim, because I just think it's a lottery. And Silver Lake obviously is one of the cheapest gold stocks on the market, but it's just impossible, I think, to understand the metrics of gold and where the gold price could go. And so, as I say, it's nothing more than a lottery. That said, Silver Lake is probably the cheapest of the gold stocks.
Let's go to our first viewer email of the night, and it comes from Tom. Tom's asking, what do we think of Navitas and carsales.com? Are they too expensive to buy? Interesting, Navitas and carsales.com. The PE multiple of car sales is astronomical, but it still keeps delivering growth.
Well, we're still long Seek. It's probably one of our preferred stocks. But that said, I 100% agree with Ben. It's starting to get pretty. Starting to get pretty fully priced. I think the valuation's starting to get a bit stretched, and you've got to make some pretty heroic assumptions with their offshore, the component of their business. Car sales for us has definitely got a bit too expensive, and I think I'm with Ben. I love the space, but it's about valuation, and tick for the space, but can't make the valuation stack up.
Okay. Our first caller back after the break is Abe. Welcome to the program, Abe.
Thanks, Kim, for taking my call. call. I'd like to ask the panel about Newcrest Mining. After all, it's one of the 20 top stocks in our ASX listed companies, and is there any light at the end of the tunnel for Newcrest and generally gold? I mean, apart from the environment of deflation, which is putting a lid on gold prices, what about supply and demand? Is there any light at the end of the tunnel for gold in the near future, let's say in a year or two?
Well, let's deal first of all with the Newcrest part of that problem, that question, because it's probably somewhat easy to find an answer to. The stock was down today, and there was that court case that came through about the exploration leases on Cadia, and obviously the market didn't like that. But under $15, this has got to be you've got
under 30, under 25,
under
20,
under 15. Maybe it's going to be under 10. It's been a long time. Well, you have to go back a long way to see the stock at these sorts of prices.
Yeah.
And I'm just wondering, is there there's some potential to buy this for a bounce, or is it just going to continue to keep rolling out the back door? Dave, your thoughts on Newcrest?
Yeah, well, I guess I was asked this about 9 months ago, Kim, and we had a valuation at the time of about $17 on it, and I think it was approximately selling for double that, and I think I was, laughed at. Anyway, so here it is at $15, and our valuation is now about $10. So our valuation's come down 7. The share price has come down about 20, and we're still not getting value out of it. It's had 4 production downgrades, as Ben said, and I'd probably continue to sit on the sidelines unless you are a big inflationist and think the gold price can go back to 15, 16, 17, 1800, $2,000 an ounce. If you do, then by all means have a crack at it.
Well, let's take our next caller, who's Peter from Lithgow. Welcome to the program, Peter.
Hi, I just wanted to ask the panel's opinion about the stock Cochlear and what the evaluation of that stock is. Its price has shown a bit of volatility over the last few months and seems to be rebounding at the moment, although it was down today something like 3 and a bit %. Is it a good time to get into this stock, and what does the panel think of Cochlear? Thanks.
Well, we had been buying this one when it had the recent pullback, and I know you were too. And it was a question of trying to find the bottom in it, and everyone thought the bottom was in the high 60s, and it confounded us all by going even lower. So, what's your take on it now?
I just should explain, Kim and Peter, when the stock got below $60, we really loaded up to the gunnels, and it was the day the Australian Financial Review came up with an article to say that Cochlear was going to get serious competition from the likes of a small company in India and a larger company in China. And my colleague at Montgomery, Tim Kelly, did a fair bit of due diligence on this supposed competition, and we ended up concluding that it was very sloppy journalism, and the competition was way overstated. So our view was that any decline below $60 was a very good opportunity, and our valuation, is neatly north of $70.